G'day and kia ora everyone. My name is Sanjeev and welcome to the Engineered Investments channel. It's that time of the year again where Australian companies start releasing their end of the year financial results for the big 2022. First cab off the rank that we're going to discuss this year is the ASX Group, our national stock exchange company, which lists itself on the Australian Stock Exchange or on itself. How's that for inception, Leonardo? To start, a little bit of a background. In 1871, the Sydney Stock Exchange formed and continued to operate for 116 years before it was merged with the other state-based exchanges in 1987 to form the Australian Stock Exchange. What's interesting here is back in the days, each of the states were independent British colonies. So the concept of a single exchange wasn't there yet, hence the multiple stock exchanges to start with. Anyway, the ASX is now Australia's primary national securities exchange, acting as a market operator, clearinghouse, payment system facilitator, and even an investment education provider. They're headquartered out of Sydney and employ 750 people or thereabouts, and their market cap ranks them at 27 out of the 2,200 companies on the Australian Stock Exchange. Looking at the front metrics, dividends have been paid continuously over the last 5 years, with the 2022 total dividends sitting at $2.36 per share. The share price has grown by 57.5% over the last 5 years. So if you had purchased shares in September 2017 for $52.09, as of August 2022, your share price would have increased by this percentage to $81.82, making it a nice growth stock that also pays dividends continuously. The 2022 revenues increased from the previous year by $81 million to 1.043 billion. The increase in revenue was attributed by three key components. The first was the annual fee income from all their listings, the higher market trading activity, and finally the increase in demand for the ASX information and technical services. So they effectively have a side hustle business unit. The earnings before interest and tax increased by 48 million to $689.2 million. The profit before tax landed in at $730 million and an increase of $92.4 million versus 2021. Looking at the shareholder metrics, the return on equity ratio increased by 0.5% from the previous year. It's a good indication that they managed to keep their costs low whilst increasing profit. And they've been keeping this return on equity ratio fairly stable, which is good to see. The debt to equity ratio is well under 70% and it is a very strong indication that the company's debt is being managed correctly. Um, yeah, nothing more to say here. The earnings before interest and tax margin has increased, should I say, decreased to 66%, indicating profitability is maintained very well. In fact, this is another area that they've been keeping very, very stable. The gross margin of 98.5% is phenomenally good. It's very nice. The business is selling the services at very good rates whilst keeping their operational costs down. So, good achievement. The profit after tax or the take-home pay, came in at $508.5 million, a $27.6 million increase from 2022. How's that for a post-pandemic recovery? So what's the outlook? Well, the company has increased its new listings by 23%, or 217 new listed companies. So the ASX is growing. They've had 10 consecutive years of continued revenue growth, which reflects that their business model is it's working well. And in simple terms, they're cashed up now. And they've been enjoying front row seats in the market due to little to no effective competition to their core businesses. In saying that, they've got a new CEO starting due to the old one retiring, which could have some impact as they settle into their new role. and they're spending a bit of coin in upgrading their 25-year-old chess system, aka the T2 electronic clearing system, T plus 2, I should say, which involves replacing all the underlying physical IT hardware and infrastructure and changing the chess system itself to a new blockchain based one, which, if you're from the IT industry, know this is an extensive overhaul. But in summary, dividends have been paid continuously over the last 5 years, and in proportion to higher financial year results. The share price has also grown over the last 5 years, giving ASX the tick of approval for being a growth and a paying stock. The front metrics are solid, and they've withstood and can withstand different market conditions, like the current Ukraine v Russia causing energy inflation around the world, as well as the handling the hangover from COVID quite well. The shareholder metrics are suggesting excellent profits are being extracted using the shareholder equity, which is always a good thing, with solid future performance to be expected. And all these characteristics typically signal a high potential for stock investment. Well, this brings us to the end of the video. Please do like and subscribe. Thank you for watching. See you next time. Ka kite ano.